Hello friends. Today we are going to look at the linkage between OE and financial KPI. We know that the OE is one of the important tools in lean manufacturing and OE has numerous benefits. OE helps identify losses, improve productivity and efficiency. It also improve quality, reduce cost, increase capacity and enhance equipment reliability. I have prepared a hypothetical case study of OE improvement and will try to show how it is linked to financial excellence. So let's start. What exactly is OE? Well, OE is calculated by integrating three various production metrics. First, availability A. It is how effectively the plant's machineries are being utilized, and availability score of 100% points out that none of the machine stopped at all during assigned production hours. But this is the hypothetical case. Every operation has some downtime due to unplanned stops like setup change, breakdown, etc. Second one is performance P. It is how speedily production occurs. A performance score of 100% specifies that a facility's machineries are operating at maximum cycle time, that is, at ideal cycle time rate. And also, machineries are operating at maximum efficiency as well as the speed at all the times while they are in operation. Generally, the performance losses are caused by slow cycles, setup and adjustments, obstructed product flows, lack of material or tools, and material jam. Third one is quality. It calculates the total number of products passing quality test compared to total products made. A quality score of 100% specifies that every product the facility makes encounters or measures quality control norms and can safely be delivered to customers or should meet the designed specification. OE is the multiplication of all the three matrices: availability, performance, and quality. Financial KPI linked to OE. The important bridge between OE and financial KPI are listed into this slide. Earning power of facility. A business ability to generate profit from the designed facility or production capacity. Like the earning power of asset, that is profitability ratio that measures a business earnings power relative to its asset base. Fixed cost. It is the costs that remain constant regardless of production, like rent, salaries, equipment cost, maintenance cost, automation cost, utilities, etc. are remain constant regardless of production. Variable cost, cost that vary with production volume like raw material, production supplies, packaging cost, energy cost, etc. are varied with production. When production increases, the variable cost also increases. Contribution margin. Contribution margin is a financial metric that measures how much a company's sales revenue contributes to covering fixed cost and making a profit. Contribution margin is important because it helps companies assess the profitability of individual products or services, identify which products to favor in production, separate high performers from products that may be eating away the profit. Since a higher contribution margin is generally better for company because it indicates that the company is generating more profit and is more successful. A higher contribution margin means that a company has more money to cover its fixed expenses. A higher contribution margin means that a company is generating more profit from its activities. A higher contribution margin can help a company reach the break-even point faster. Break-even point is the point at which business total revenue equals to its cost, resulting in no loss or gain. Let's go through a hypothetical case study where we are going to evaluate the impact of OE improvement through maintenance and automation. Current state. The current OE of production facility is 70%. The fixed cost of a current facility is 30 lakhs. A product being made through a production facility, the selling price of the product per unit is 120 Indian rupees and variable cost per unit is 40 rupees. Current production capacity is 6 lakhs per year. Company's goal is to improve OE to 85%. For that purpose, company has decided certain actions to meet the target. Those are maintenance of the machine to improve availability by reducing the downtime and improving uptime of the equipment, and also propose certain automation to further enhance the availability and performance of the production facility. Company envisaged the goal of 85% OE with the investment of 5 lakhs in maintenance of the machine and 8 lakhs in automation. Company prepared a roadmap to reach the targeted OE. The current state says that the OE impact on usable production capacity is lesser than the available production capacity since efficiency of the production facility is 70%. Hence, OE impact on usable production capacity is equal to 70% multiplied by 6 lakhs is coming to 4 lakhs 20,000 units per year. How much amount of revenue that can be generated from the usable production capacity? Well, the revenue is equal to usable production capacity, that is 4 lakh 20,000 multiplied by selling price. The selling price is 120 rupees per unit, that is coming to 5 crore 4 lakhs. We know that the variable cost varies with respect to the volume and revenue. Hence, the variable cost is equal to usable production capacity multiplied by variable cost per unit, that is 40 rupees per unit. Altogether it is coming to 1.68 crore. Now remember the formula of contribution margin from previous slide. It is equal to subtraction of revenue and variable cost. Contribution margin is equal to revenue minus variable cost is coming to 3.36 crore. Net profit is equal to contribution minus fixed cost, that is coming to 3 crore 6 lakhs. Remember the company improvement plan. Company plans to reach the goal 85% OE with the investment of 5 lakhs in maintenance and 8 lakhs in automation to enhance equipment reliability, efficiency and performance. Company put a lot of efforts to achieve the goal by utilizing provided funds for maintenance and automation of the equipment. Let's see how company projects proposal and assess the benefits, financial benefits of OE improvement into the upcoming slide. Now we will see the performance achieved by the company through the improvement carried out by the conducting maintenance of machine and automation of the equipment. In a improved state, the OE impact on usable production capacity is equal to multiplication of OE and production capacity. That is 85% into 6 lakhs is coming to 5 lakhs 10,000 units per annum. Revenue is equal to the usable production capacity multiplied by selling price coming to 6 crore. Variable cost is equal to usable production capacity multiplied by variable cost is coming to 2 crore 4 lakhs. Contribution margin is equal to 4 crore 8 lakhs, and potential net profit is equal to contribution margin minus total fixed cost. Remember the total fixed cost, that is the summation of all the fixed cost booked during current state and cost that are incurred during improved state, that is applied for maintenance and automation of the equipment, that is altogether coming to 3 crore 65 lakhs. The financial benefits are projected into this slide. Incremental revenue growth from OE 70% to 85% is equal to revenue when OE is 85% minus revenue when OE is 70%, is coming to 1 crore 8 lakhs. Incremental contribution margin is equal to contribution margin at 85% less contribution margin at 70%. It's coming to 72 lakhs. Net profit growth is equal to net profit at 85% minus net profit at 70%. It's coming to 59 lakhs. ROI of investment is equal to 453%. This ROI is very lucrative and management can consider this as a potential measure to enhance the profitability. If company achieves the goal of achieving 85% OE within 6 months, then company can recover initial investment within next 3 months when the company is running at full production capacity. There are some potential risks and challenges coming along the way to achieve the targeted goal and desired profitability. These are unforeseen maintenance costs incurred while conducting maintenance of machine and equipment. The initial projected budget may not be sufficient for maintenance in future since unforeseen maintenance can occur which will raise the maintenance cost. Operational disruptions. There are some operational difficulties after going through maintenance and automation of the production facility which will raise new consequences that can impact on current state of the productivity. And market demand fluctuations may reduce the revenue and thereby reducing the optimal profitability. There are some measures that can be adopted to reduce the risk impact. That is regularly monitoring the maintenance and automation activity and having clear roadmap of OE improvement and further monitoring. There are some steps that can be adopted during improvement of OE in general. Those are assessing current OE, identifying bottlenecks, planning and execution actions, monitoring and measuring improvement with respect to the baseline current state. There should always be a plan B when plan A is not workable. The contingency plan should be always there to mitigate the risk impact. Few key takeaways. Improved OE leads to better utilization of capacity, financial impact, significant increase in revenue and net profit, strategic investment, high ROI can be achieved from targeted maintenance and automation. Final conclusion. Well, OE improvement through maintenance and automation drives substantial financial benefits. Company needs to prioritize OE initiatives to achieve operational and financial excellence. This is a very short introduction of a linkage between OE and financial KPI. Thanks friends. If you like the content, then please do comment, like, share and subscribe my channel. Bye bye. See you next time.